We have a very specific picture of what a successful tech founder looks like today. The hoodie, the keynote stages, and the massive venture capital rounds. It's an ecosystem built almost entirely on glossy PR and performative hype. In biology, there's a concept known as the peacock paradox. A male peacock grows a massive, heavy tail entirely to show off to mates. That tail is a costly signal. It requires immense energy to maintain, slows the bird down, and makes it incredibly vulnerable to predators. In the startup world, building flashy consumer apps and signing leases for giant glass offices are just costly signals. They are driven by founder ego, burning cash at an alarming rate and leaving the company completely exposed to market shifts. Now compare that to Amit Acharya or Peter Gassner. These are first-generation billionaires who have quietly built massive, unglamorous B2B empires. While everyone else fights to build overhyped consumer apps for social validation, generating a true billion-dollar cash flow requires killing your ego first. Think about software for plumbers, FDA tools for pharmaceutical companies, and raw corrugated box manufacturing. These traditional sectors quietly print cash month after month, while trendy direct-to-consumer brands and ride-sharing platforms bleed investor money and operate at massive losses. The exact type of business you would be embarrassed to pitch at a dinner party is precisely the business that generates enough reliable cash to pay for the party. When Peter Gassner pitched a CRM for drug reps, or when the founders of ServiceTitan pitched dispatch software for plumbers, venture capitalists essentially laughed them out of the room. That widespread investor bias and founder ego acts as a massive protective moat for anyone actually willing to do the work. These are gritty, blue-collar environments. The end users are exhausted contractors managing physical labor and messy supply chains, far removed from Silicon Valley aesthetics. Because ego prevents ambitious competitors from entering these spaces, the founder who actually shows up is gifted a multi-year head start. This visualizes the first pillar, high switching costs. Once a business hardwires software into payroll, dispatch, and billing, they are terrified to tear it out. This lock-in creates the second pillar, high margins. The provider can increase prices, while fixed costs stay virtually flat. Take Angus Chang's bank statement converter. It is a simple piece of code that scrapes PDF bank statements and turns them into CSV spreadsheets. Today, that utility returns $20,000 a month in pure profit to its solo founder. The third pillar is solving basic human needs. Whether it is contract staffing, bulk garlic supply, or raw physical infrastructure, they serve physical realities. Tying a business directly to these essential physical needs guarantees demand. Even in a severe economic downturn, cities still need construction, and hospitals still need staffing. The cash flow is practically recession-proof. Combine sticky customers, fat margins, and essential demand, and you get a company mathematically worth significantly more per dollar of revenue than its heavily funded, hyped-up competitors. From the outside looking in, modern global industries appear highly organized. When you order a product online, the delivery process seems seamless and hyper-efficient. But behind that facade is a logistical nightmare. Global shipping is largely run on 1970s-era fax machines, physical carbon copies, and manual data entry. This is exactly why Takasato built Shipio. He deliberately chose not to touch the physical assets. No buying ships, no renting warehouses. He just digitized the messy paperwork flowing between them. True, boring innovation does not require inventing a new market. It is simply about laying a thin layer of modern digital efficiency over a massive, ugly analog process. Right now, roughly 80% of these highly profitable offline businesses are run by an aging generation. These legacy owners built massive industrial empires entirely without smartphones, automated software, or digital marketing. They used sheer brute force. This chart shows the impending demographic collision. We are facing a steep decline in active legacy owners as they prepare to retire and sell, intersecting directly with a sharply rising demand for digital integration within those exact companies. This demographic shift creates a strictly time-bound window. In the next 3 to 5 years, you have the opportunity to capture immense market share before modern competitors even realize these industries exist. Stop chasing complex AI models. Ignore the vanity metrics of venture capital funding. Hunt for the problems currently solved with clipboards, physical filing cabinets, and manual data entry. Find those analog bottlenecks and build a quiet solution. The perfect, most profitable startup will never be on the cover of a magazine. It will be the boring one nobody has ever heard of.